Have you ever stopped to ponder why some people seem to accumulate wealth effortlessly, while others struggle financially no matter how hard they work? It's a perplexing question, isn't it? The answer lies in the concept of the financial matrix. It's a system, you see, that governs how wealth is distributed. And who pulls the strings of this system? Well, it's none other than the governments and banks that seem to have quite a hand in it. This is no accident, but a result of a system we're all part of, a system we call the financial matrix. So what part does the government play in this financial matrix? The government, in essence, holds the reins of the economy. It wields a set of tools that allow it to steer the economic landscape, influencing the ebb and flow of wealth within a nation. This is achieved through fiscal policy, monetary policy, and the ever-present mechanism of taxation. Fiscal policy refers to the government's approach to spending and taxation. It's like a nation's budget. When the government spends more than it earns, it's running a deficit. When it earns more than it spends, it's running a surplus. This policy can be used to stimulate economic growth, but it can also lead to inflation and debt if not managed carefully. Monetary policy, on the other hand, is managed by the central bank and involves controlling the money supply. It's like adjusting the faucet of a nation's wealth. By manipulating interest rates and buying or selling government bonds, the central bank can influence the overall level of economic activity. When done right, this can help stabilize the economy. However, when mismanaged, it can lead to boom and bust cycles. Lastly, we have taxation, the most direct way the government influences your wealth. Taxes are essential for funding public services, but they also take a bite out of your income and savings. The structure of a nation's tax system can significantly impact wealth distribution. Progressive tax systems, where the rich pay a higher percentage of their income in taxes, can help reduce wealth inequality. However, regressive tax systems, where the poor pay a higher percentage, can exacerbate it. But it's not just about the tools. The government also sets the rules of the game. Regulations can protect consumers, promote competition, and ensure fair play. But they can also create barriers to entry, stifle innovation, and favor certain players over others. In the end, the government's actions can either promote or hinder wealth accumulation. They can create opportunities for prosperity or barriers to it. They can foster an environment where wealth is widely distributed, or one where it is concentrated in the hands of a few. Thus, the government, with its policies and regulations, plays a decisive role in the distribution of wealth. And what about the banks? How do they fit into this picture? Banks, these omnipresent financial giants, play an intricate role in the wealth landscape. They have a unique ability, a sort of financial alchemy, if you will. They can create money. This happens through a process called lending. When a bank issues a loan, it's not handing over a stack of cash it had sitting in a vault. Instead, it's creating new money, right there on the spot. Now, this might sound like magic, but it's actually a cornerstone of our modern economy. This ability to create money gives banks an incredible amount of influence over the flow of wealth. They decide who gets loans and who doesn't, who can start a business, buy a house, or go to college. They control the credit and set the interest rates, deciding who gets to climb the economic ladder and who gets left behind. Of course, this power isn't wielded in a vacuum. The choices banks make are influenced by a slew of factors, from government regulations to market trends. But the basic fact remains they have a significant say in who gets a slice of the wealth pie and who doesn't. This system, where banks can create money and decide its destination, can contribute to wealth inequality. The rich can get richer, while those without access to credit can struggle to break out of poverty. In essence, banks have the power to create money and decide who gets it, significantly influencing the wealth distribution. So, what does this all mean for you? Well, let's tie it all together. We've taken a deep dive into the financial matrix, a complex web of systems and structures that governs how wealth is distributed. We've seen how governments play their part through tax policies, regulations, and monetary interventions, which more often than not, favor the wealthy and leave the rest of us grappling with financial uncertainty. We've also seen how banks wield their power through loans, interest rates, and other financial products. They are the puppeteers, pulling the strings and shaping the economic landscape to their advantage. What's clear is that this matrix is not designed with your wealth in mind. It's structured to keep the rich richer and the poor poorer. But here's the kicker: you're not powerless. Understanding this system is the first step towards navigating it. Knowledge, after all, is power.